Once upon a time, the world's economic system was tethered to something shiny: gold. This was called the gold standard, where the value of money was directly linked to a fixed amount of gold. In simple terms, if you had $1, you could theoretically exchange it for gold held by the government. It gave money a sense of stability and made sure governments couldn't just print cash willy-nilly. But by the 20th century, cracks began to show. During the Great Depression and World War II, countries needed more flexibility to spend and stimulate their economies. Being chained to gold limited their ability to adapt. Then came the 1970s, when the US, led by President Nixon, officially abandoned the gold standard and the world shifted to fiat money, currency backed by trust in the government, not precious metals. We will do another video on just this process, but for now let's just put a pin on it. This was a game changer. Suddenly, central banks had more freedom to manage economic ups and downs. They could print money, control interest rates, and use monetary policies to respond to economic crises. Sure, it meant the system relied more on trust, but it also allowed for much-needed flexibility in a complex global economy. If you've ever wondered how the economy sort of works, you'll inevitably bump into a big, mysterious institution called a central bank. It's like the wizard behind the curtain in The Wizard of Oz, pulling levers, flipping switches, and trying to keep the financial system balanced. But what do central banks actually do? Why are they so powerful, and why do they suddenly seem to have so many tools in their toolbox? Let's break it down. Their goals, how they get the job done, and how they beefed up their powers after the great financial crisis of 2008. Imagine going to the grocery store one day and a loaf of bread costs $2. The next week it's $10. By next month you're trading family heirlooms for toast. That chaos, it's inflation gone wild. Central banks' main job is to keep inflation under control. They aim for a sweet spot. Not too high, not too low. Most central banks shoot for around 2% inflation annually because a little inflation keeps the economy humming, like oil in an engine, but too much will send prices spiralling. Deflation, on the other hand, is just as bad. Think 1930s style Great Depression vibes, where everything gets cheaper, but no one has money to buy anything. The other big goal? Employment. Central banks want to foster economic conditions where everyone who wants a job can get one. If too many people are unemployed, it means the economy isn't living up to its potential, and we're all missing out on more productivity, spending, and overall happy vibes. But here's the kicker. Achieving price stability and full employment at the same time is a tricky balancing act. If a central bank pushes the gas pedal too hard to get more jobs, by making borrowing cheap and easy, it could overheat the economy, leading to, you guessed it, too much inflation. Ever hear of a bank run? It's when everyone panics and withdraws their money at once. Modern central banks exist, in part, to make sure this kind of chaos doesn't happen. They act as the lender of last resort, stepping in to provide emergency cash, liquidity, to banks during crises so you and I can still use our debit cards without fear of them being declined. How do they actually achieve these goals? Here's where central banks get creative. Think of them as chefs with a recipe for economic stability. Their main ingredients are 1. Interest rates. Interest rates are a central bank's bread and butter. By adjusting a key rate, often called the policy rate or base rate, they control how expensive or cheap it is to borrow money. When interest rates are lower, people borrow more, businesses expand, consumers buy stuff, and the economy gets a boost. The opposite happens when they are higher. If you've ever celebrated a low mortgage rate or cried over rising credit card interest, thank or blame your central bank. 2. Open market operations. This fancy-sounding term just means buying or selling government bonds in the market to influence the money supply. When central banks buy bonds, they inject cash into the economy, kind of like sprinkling water on thirsty plants. When they sell bonds, they take money out, cooling things down. It's a bit like tuning a guitar, adding or taking away tension until everything sounds just right. 3. Reserve requirements. Central banks can tell regular banks how much cash they need to hold in reserves, kind of like forcing them to hold an account with the Bank of Banks, Capo di tutti capi. Lower reserves mean more loans, more spending. Higher reserves mean the opposite. Reserve requirements nowadays, however, are less like requirements and more like inducements. The Federal Reserve, for example, since 2020, doesn't require banks to hold reserves, but banks do anyway because the Fed pays them interest on reserves. They also use these reserves to settle accounts between them. If people sent money from Bank A to Bank B, and vice versa, at the end of the day, the bank that owes settles its debt by transferring reserves to the other bank's Fed account. Naturally, the rates that the Fed pays to the banks for holding reserves provide a sort of minimum earning threshold for the banks. Any investment opportunity has to earn at least as much as the Fed pays, so that's how the Fed affects the interest rate in the economy nowadays, by providing a benchmark. So for example, if the bank is going to give you a mortgage, the interest rate you pay on that mortgage is going to be the Fed rate that the bank makes plus something, depending on your profile as a borrower. This is a fascinating topic, and the plumbing here is deep and complicated. If there is enough demand, we can do a video on this. But for now, take a look at our double-entry bookkeeping video, as it is closely related. The Great Financial Crisis. Time to supercharge the toolkit. Back in 2008, the financial system had a near-death experience. Global banks were on the verge of collapsing, mortgage markets crumbled, and suddenly the usual tools like interest rate cuts weren't enough. Central banks needed to get creative, fast. So, they expanded their toolkit with moves that would have sounded crazy a decade earlier. Here are the highlights. 1. Quantitative easing, printing money without the ink. When lowering interest rates to nearly zero didn't work, central banks invented QE. It's like turning on a giant money tap. Central banks started buying massive amounts of financial assets, like government bonds and mortgage-backed securities, from banks. The idea? When banks have all that extra cash, they'll lend more to businesses and people, boosting the economy. It also lowers long-term interest rates, so you can snag a 30-year mortgage at a lower cost. Of course, QE has its critics. Some say it inflates asset prices, making the rich richer. And there's always a fear of too much money leading to runaway inflation. But desperate times called for desperate measures. These desperate measures were certainly expensive, as they increased the Fed's balance sheet from $800 billion to $2 trillion, and today it stands at around $8 trillion. 2. Forward guidance, talking the economy into behaving. Sometimes just talking can move markets. Central banks started giving forward guidance, telling people, hey, interest rates are going to stay low for a while. This gave businesses and investors confidence to borrow, invest, and spend. It's like a coach telling their team, don't worry, we've got this game in the bag. Even if the team is losing, morale improves and they start playing better. 3. Negative interest rates. In some countries, hello Japan and parts of Europe, central banks got so aggressive that they introduced negative interest rates. That's right. Banks had to pay to keep their money parked with the central bank, which forced them to lend more. The upside, it encouraged spending. The downside, it's kind of like financial science fiction, and long-term effects are still debated. Are central banks heroes or just humans with big jobs? Modern central banks are fascinating beasts. They have massive influence over our lives, from the price of your next car loan to whether you keep your job during a recession. The GFC forced them to get creative, and while they stabilised the system, they also raised some big questions. How much power is too much? Are there risks to constantly expanding their toolkit? Here's the thing, central banks aren't perfect. They're run by incredibly smart people, but they're still human. They make tough calls with incomplete information and hope they've struck the right balance. But one thing's for sure, whether it's cutting interest rates, buying bonds, or talking us into economic optimism, central banks will always be there in the background, trying to keep our financial lives as stable as possible. Think of the central bank as a very powerful technology. In the wrong hands, it can do great damage. In the next video, we will explain why central banks need to be independent, but not too independent. It's a fine balancing act, and it's a system that goes haywire once in a while.